Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance, and today I'm going to be talking about when I might deploy a dynamic hedge. Now, a dynamic hedge is a position that makes money if the stock goes down. So what I use it for is for positions when I have significant risk to the downside and I want to reduce some of that risk. I'm going to show you the trade I did today on Chevron. And thanks again, as always, for joining me. Remember, it helps my channel a ton if you hit that like button down below, or better yet, leave a comment. Ask me a question about any stock and I will respond. I like to respond to all my comments. So thank you so much for joining me today. Now, if we take a look at Seeking Alpha, this is one of the services I use. You can see that it's got a strong buy rating and why I might want to own this stock. It's a highly profitable company, but one of the problems right now is the valuation. The valuation is actually a little bit high. Now, in my particular case, this morning when the market opened, I actually have a short put in play. Now, short put is an agreement to buy shares, and it is an agreement to buy them at a specific price. Now, if I look at my portfolio, I'm actually holding the August 12th 160 put, and I'm holding it short, which means I have an agreement to buy shares for $160 per share. I placed this trade a little while ago. I've actually been rolling it for some credit, but the stock is trading at 153. Now, when I look at this, I don't mind paying 160 for the stock because we can see that it is trading, just slightly above its recent trend, but it is uptrending, and I want a long position on this overall, which is why I'm holding an in-the-money put. But I have risk to the downside, and you can see that this stock could move down. Even looking at its current Bollinger Bands, the 20-day Bollinger Bands, there could be a significant move to the downside. And because this position is in the money, if the stock does move, I am losing money pretty rapidly on this down move. Now, if I looked at the profit loss chart on this position, we would see that there is quite a slope to the downside and there's no upside risk. It's just short put. So it expires worthless if the stock goes up above 160, but I have risk to the downside. And I want to eliminate some of that risk today. Now, if I pop over to the Discord chat, you can see that I posted this trade today. I said that the stock was trading at 154 and I have a short put in play that has considerable risk to the downside. This trade will reduce that downside exposure somewhat at the cost of a bit of theta decay. Now, if I look at my brokerage, the theta decay on the Chevron position is actually $12 in theta decay. That's how much extrinsic value is being decayed per day for holding this option. That's how I make money as an option premium seller. I'm short this contract and I am making money due to the time passing. But it doesn't mean I don't have risk to the downside. So what I did was I put on a trade where I bought a call. And now buying a call by itself is actually a bullish trade, and I pay a debit to open that. So in this case, I paid $13.17 for one contract. And so it was a debit from my account of $1,317. And then what I also did was I sold short 53 shares. Now, the beautiful thing about this is that I can dynamically hedge against a short put position because I don't already own shares in my account. If I was long shares and was trading a covered call, I wouldn't be able to do this dynamic hedge. But in this case, a dynamic hedge working with this short put that's in the money is a perfect hedge for it. And I'll show you why. What I'm doing, the second component is selling the 53 shares, and I'm selling it at the market value. At the time, it was $154.45 a share, and I got a credit of $8,185. Now, this works out to a net credit. I get deposited into my account $6,867. Now, don't think for a second that that's my potential profit on this. That is not the case at all. This is just money that I have been given and I am holding. But at some point in time, I'm going to have to buy back these 53 shares. Now, you watched my video the other day on dynamic hedging and how it works. If the share moves around a bunch, it will actually make or lose money depending on the movement. If we take a look at the profit chart, you can see why. So what I've done is I have bought the January 20th a 155 call, and I paid that $1,300 for it. You can see this is the screen grab. And I also sold 53 shares. Now, because I never had any shares in this account at all, I actually now am short shares. And what the profit profile looks like is it looks like this V. It is definitely going to cost me money if Chevron does not move. If Chevron stays in this range, it's going to cost me money daily. And I can figure out how much it's going to cost me daily by just looking at my risk navigator in Interactive Brokers. Now, the Chevron 155 call has a cost, and that cost associated with it is negative $5 per day. So I have a put that's making $12 a day, and I have this dynamic hedge which is costing me $5 a day. But net, both these together, I actually make $8 per day. Now the beautiful thing about this trade is that if Chevron goes down, this dynamic hedge makes money while my short put is losing money. Now it doesn't mean that I am bearish on the position at all. What I'm doing is I'm reducing downside risk. If we look at it overall, let's take a look at this chart. You can kind of see now what my current position looks like. The dotted line is today. So if Chevron was to rally, which is what my expectation is, I still am making money. My account valuation will be increasing. This would be my potential profit going up. Now, if it goes down, it's not going to be as steep as before. Before, if it dropped down to, a level down here around 117, I would have been down almost $4,000. But this hedge is going to make about $1,000. Therefore, my risk on the downside is only $3,000 if Chevron drops to 117. So this dynamic hedge works in a way that protects and evens out this slope, and it still gives me upside potential. Now, I can modify this further. I can start to sell calls up in this upper level to neutralize this even further, and I can manipulate this however I like. And that's the beauty of this type of trade. I can adjust how many short shares I have depending on how much risk to the downside I want. Now, obviously at these levels, if we look back at TradingView, we're having a little bit of some down movement these last couple of days, but overall I am quite bullish. We saw the earnings come out. There was a jump on earnings. It's coming back down towards these moving averages. And my expectation is the stock is going to move up, but I also want to protect my account in case it goes down. So I hope that sheds some light on when I might deploy a dynamic hedge. If this helped you guys in any way, shape, or form, remember to hit a like. It helps the channel a ton, and let's get rich together. Thanks so much for watching. See you very soon.